Hi ladies and gentlemen, this is Game of Trades, and today I'm going to analyze the S&P 500 from a long-term perspective. I'm going to see if a stock market crash is a possibility in 2019 or perhaps in 2020. So let's get right into it. This is a monthly chart of the S&P 500. I'm actually going to stay mostly on the monthly. Because I think it just tells us such a big story in regards to bull and bear markets, at least the most recent ones. And I'm going to put two indicators, the MACD and the RSI. If you followed me for a while, you'll know that I love these indicators and that I know them extremely well. There's a lot you can tell with just the MACD and the RSI, so that's exactly what I'm going to do. So the first thing I see on the MACD on the monthly chart is the crossovers with the blue and the red line. So you can see there have been a few of these in the past 20 years or so. And as you can see, most of these do happen at the end of an extended uptrend. So you can see right here we had a crossover back in the 2000 dot-com bubble, right before the 2000 crash, and then right at the end of this first stock market crash, we had another crossover back in 2002, 2003. Same thing happened in 2008. We had a huge stock market crash in 2008. Same thing happened back in 2015, another crossover, and we have another one right now. So will this time be any different? We'll see, but from my own opinion, I think this is a sign of a slowdown in the economy, and this is not something that I'm going to ignore when it comes to the next few years of my trading. Now, I'm obviously going to get comments saying, well, we did have this crossover back in 2012, and it didn't really amount to much. Well, first of all, it did give us a nice double-digit correction, but this was right coming off the 2008 lows. So, a whipsaw signal, a long-term whipsaw signal, this early in a bull market is only normal. What we have right now is at the end of an extended uptrend. So, right after 10 years of, bull market action, you get this kind of bearish signal. It's not a very good sign. Now, looking at the RSI, I see divergence on the monthly chart. And when you have this kind of technical reading on the monthly chart, RSI divergence is almost 100% accurate. There is rarely whipsaw signal. So, on the MACD we had the small whipsaw signal in 2011, and same thing goes for back in 1998. During the dot-com bubble, we did have a whipsaw signal on the MACD. So, technically, this could be a whipsaw signal. Now, one thing on the RSI that we have is price making higher highs. You can see that, just price keeps on going higher and higher, whilst the RSI is showing readings that are going lower and lower. And you can see that this continues all the way to the peak, and once the market gives in, well, you get a huge correction. And we had the exact same thing here back in 2007. We had two consecutive RSI readings. One right here corresponds to this top right here, and one RSI reading there, which is slightly higher on the price chart. And when we had these two readings within a couple months, we had a huge drop in price. So, Divergence, I like to say that it's almost, 9 out of 10 times it will play out, especially when you see it on the RSI and on the MACD. Right now we don't have a divergence on the MACD, but on the RSI you can clearly see that we're making higher highs right here, 3 higher highs, whilst the RSI is clearly making steep lower lows. And when you get steep readings, the corrections or the rallies following uh, tend to be more powerful and more quick. So that's one thing that we see on the RSI, and another thing to watch on the monthly chart. Now, the last thing that I want to address on the S&P 500 on this long-term video is the Fibonacci retracements. Now, I am a big believer in Fibonacci retracements, not particularly for an indication of levels, but more on what a healthy uptrend looks like or a healthy downtrend looks like. Price does not go up forever. You need to have ups and downs within the uptrend. Um, you know, uh, you can consider from 1980 all the way to now, this is an uptrend, and we've had ups and downs along the way, and it's only natural. Now, sometimes, just like in 2008, it is an unhealthy correction with a huge economic problem behind. But in the case for the dot-com bubble, it was just a retracement of the huge gains we made back in 1999, 1998. We had just a retracement of these back to a Fibonacci retracement level, and then we resumed the uptrend. So, let's take a look at that. Let's take a look at the Fib retracements back in 2000, what they look like. So you can see that Fibonacci retracements start at the bottom of the uptrend and all the way to the top right there. And you can see that the price actually retraced all the way back to the 50% retracement, which is perfect. It is perfect for a healthy correction. So a retracement back to the 50 is perfectly fine and healthy for an uptrend. Now, 2008, if you take it from the bottom here, it was an unhealthy correction. But again, this is due to an economic problem in the vaccine, which I'm obviously not going to cover a fundamental analysis of the economy right now. But if there were huge problems in the economy, not only we would have a crash going back to the fib retracements like we did in 2000, but we would probably end up going much lower. But again, I'm not saying that there's a fundamental problem in the economy right now. I just want to say what is the minimum correction that I'm waiting for in 2019, and that would probably include a crash. So let's take a look at the fib retracements in 2019, all the way from the bottom in 2009. Going to the top here, we hit the first 23 retracement level back in the end of 2018, but there is still the 38 left and the 50 that we could reach. And if we want a healthy correction in the markets, we would want to see a retracement back to the 50 retracement level, and this would be healthy. It would not be a huge crash like 2008, like everyone, like the it would not be a huge crash like we did in 2008 with the entire economy going down the toilet. No, it would just be a simple retracement, a simple end of economic cycle, and we would have to wait for the next one. And what is very interesting about these two levels that I see, 38 and 50, is that if you combine them with actual price levels right here, put a line on the 38 and a line on the 50, you end up with two lines at two perfect resistance support levels that would be perfect for a bounce after a decent correction. So again, um, not only are these healthy price levels for a good correction in the economy, but these are actual price levels that we've created back in 2015. So, in a sense, what happened in 2015 is again healthy. You need to have these kind of consolidation periods to create some type of support under us, or if we didn't have this, we would probably be able to crash all the way back down to the 2008 levels. So this is healthy action, just like this is, and probably a touch of these levels again, and that would include a 27% move down from where we are, and that is technically a crash, and that is technically a bear market type of price action. So that's about all I wanted to cover in this video. I hope you enjoyed the video. If you did, make sure to drop a like and subscribe if you haven't already. In the meantime, good luck on your trading, and see you next time.